There will be no escaping this. I'm your host, Steve Van Metre, and thanks for joining me today. And every American household will be severely impaired by the time this is over. Let's over to CNBC, where we picked today's story up with a headline: 60% of Americans are living paycheck to paycheck heading into peak holiday season. And as we note, as of October, 60% of Americans were living paycheck to paycheck, according to a recent Lending Club report. A year ago, the number of adults who felt stretched too thin was closer to 56%. And this is far worse than I thought. Now, I knew things were bad, but what we want to note here is the trend. The trend is getting worse. And what are we hearing from the Fed? That the economy is strong, that there's tons of jobs and wages are rising. And yet, the question we should be asking is, why are Americans saying that they're getting worse? Well, because the reality is things are. And looking at this real disposable personal income chart, that we can note that against inflation, and this is what real means, it's inflation adjusted disposable personal income is at negative levels. It's very negative. You go back and look throughout history, all the way back into the 1950s, and we don't see a trend this bad. Not only that, we've never really seen it this negative, except at the depths of a recession. Now, we've come off some very low levels here, but this is having a severe impact. You know, when people's disposable income is negative from where it was the prior year and the year before that, that doesn't bode well for their sentiment, their desire to spend, and their overall happiness level. And that is a huge problem for the economy, as we're about to see. More consumers who have historically managed their budgets comfortably are feeling the financial strain, which will impact their spending behavior as we head into the holiday shopping season. And then this is the key point here. We're heading into the holiday season, and we know there's a number of things where retailers are at, what they need to happen, and where are consumers at. They're in a dire situation. And that's why when we come out of this, as we see, it's going to be pretty bad. And that's the case we're going to make in today's show. Let's continue on. Because not only are the day-to-day expenses higher, as we already know, but inflation has also caused real wages to decline. Now, when we talk about real wages, again, we're meaning inflation-adjusted wages. So not only is personal disposable income down, but inflation-adjusted wages are down. And what that means is simply people are getting raises. We know that, we hear that, we see it in the news, we know that in the data, but those wages increases are not keeping up with inflation. So it's like, here, have a nice raise. By the way, prices went up even more. And how much more? Well, according to the data, real average hourly earnings are now down 3% from a year ago. So again, you see, according to the Bureau of Labor Statistics, that raises are not keeping up with inflation, and that is going to make a huge problem for this holiday season. A separate report by Salary Finance found that 2/3 of working adults said they are worse off financially than they were a year ago. And of course, we could just put up a chart of the Consumer Price Index, and we note that when prices rise, they rise faster than wages. So it should be very obvious to all the policymakers out there that yes, virtually everybody is worse off than they were before, thanks to rampant inflation. Already, credit card balances are surging. We'll put this one as a no surprise, up 15% in the recent quarter, the largest annual jump in more than 20 years. And as we've noted on this show in the past, the reason this happens is because when consumers can't keep up with inflation, the first place they turn to is their credit cards. When the credit card companies say no more, they cut their limits, they stopped expanding how much debt they can borrow, that's when spending starts to hit a wall. Because what are consumers hoping for? That eventually prices will moderate, or they'll stop their growth and their wages will increase. That never is how things go, but that's what we're going to see in the months to come. And roughly half the shoppers said they'll buy fewer things due to higher prices, and more than 1/3 said they will rely on coupons or other money-saving strategies. Again, we talk about what the big problem here is going into the holiday season is that retailers need people to spend, and not just in a little way, in the biggest holiday season they've ever had. And why is that? Well, I think you already know. Retailer inventories are at record levels. So we know that retail inventories are very high. They need people to spend, and the data says they're not. More consumers also plan to finance their purchases this year with credit cards and buy now, pay later. So, as we look forward into next year and we think about where consumers are going to be, as it is now, their wages are not keeping up with inflation. Their disposable income is negative from where it was a year ago. And now they're going to have even more debt going into 2023. If you've ever wondered why recessions, at least modern day recessions, tend to start in the early part of the year, you're getting a good indication of why, and we'll get into that in a little bit deeper. Holiday spending could come at a high cost if it means tacking on additional credit card debt, just as the Federal Reserve raised interest rates to slow inflation. Credit card debt is certainly easy to get into and hard to get out of, as high inflation and rising interest rates are making it even harder to break free. And of course, we know what is eventually coming is not just higher credit card rates, but even higher than they are now. And again, when is that going to impact most Americans? The first part of next year, it's going to be pretty ugly. Credit card rates are now 19% on average, an all-time high, and those rates will continue to rise since central banks have indicated even more increases are coming until inflation shows a clear signs of pullback. And if we can note that this is absolutely correct. We talked about this on a show probably I think last week, where credit card rates lagged the federal funds rate by 2 months. So here we can see commercial bank interest rates on credit card, those are those blue dots, and followed by the federal funds rate. And you can note that as the funds rate rises, yes, credit card interest rates are indeed headed higher. And if this hits credit cards with a 2-month lag, then we know in the early part of next year, consumers, for all this holiday spending they charge, are going to see an even larger interest cost. And if the Fed continues with their plans to increase rates in December into early next year, the cost to pay for the holiday is going to be steep, and that's going to lead to a lot less spending in the first part of the year. It makes it more likely for credit card companies to increase their interest rates. They should reword that and say it means credit card companies are going to raise their interest rates, making the money you owe even more expensive over time. The rise in inflation and interest rates means consumers need to be particularly mindful. Really, what consumers are going to do is face the first part of this year with a record amount of debt, with record high interest rates, and that's going to lead to a slowdown in spending. And if you've kind of wondered, again, how do we see recessions tend to start in the first part of every year now when we do have those cycles hit? It's because after holiday seasons, after there's been a lot of spending, what do we see consumers do? They focus on paying down their debt, they cut their spending back, companies start laying off, and then the dominoes start to fall and the economy slips right into recession. And there's data that's validating that this is likely to happen. As U.S. household debt jumps the most since 2008, even as credit card rates surge. Households added a whopping $351 billion in overall debt last quarter, taking the total to $16.5 trillion, according to data released by the Federal Reserve. That's an increase of 8.3% from a year earlier, nearly tracking the increase in the Consumer Price Index, the most since a 9.1% jump in the first quarter of 2008. The debt figures notably aren't adjusted for inflation. So again, the Federal Reserve is validating everything we're seeing here, saying, look, consumers take on a huge amount of debt prior to recessions. What happens is banks tighten lending standards, which we've been talking about on the show. They cut off the amount of debt consumers can borrow, and next thing you know, they're forced to retrench, and not just retrench and pay down that debt, but they've got to cut their other discretionary spending. Again, that leads to layoffs, and of course, there's the case for recession, and you're seeing it coming now in the first part of 2023. As credit card debt also increased the most in 20 years, with balances rising by 15% from a year earlier. The surge comes as average interest rates on card borrowings climbed above 19% and is going even higher. With prices up more than 8% from a year earlier as of the quarter's end, it's unsurprising that balances are increasing. The real test, of course, will be to follow whether these borrowers will be able to continue to make payments on their credit cards. And I think that's going to be a story for next year, is when we start to see people say, look, I need to pay for shelter, I need to pay for food, I need to pay for energy, and I have to stop something. and they're going to watch. You'll see they'll stop making payments on their credit cards. At first, it'll just be down to the minimum. Then they'll get into delinquency, and the next thing you know, they'll stop paying because they'll have no choice. In addition to levering up on credit card debt, Americans are also tapping home equity to help meet spending needs. For the second consecutive quarter, home equity lines of credit increased. And of course, this harks back to the great financial crisis when consumers were borrowing heavily against their houses. Remember, they were considered ATMs because they only went up in value. So now we're potentially seeing real estate prices fall as people tap their equity lines. They could be in a negative situation where they owe more than their houses are worth. And you can just see all of this start to accumulate and fall. And what is the catalyst? It's all coming when this is over. And what is that? It's the holiday season. You'll watch and see early next year, things are going to change in a big way. And if we look now who is completely clueless as to what is coming, you already know the answer. It's the Fed. As Fed Collins expresses hope that inflation can be tamed without hitting jobs. And we'll say, well, not likely. By raising rates, we're aiming to slow the economy and bring labor demand into better balance with supply, she said. The intent is not a significant downturn, but restoring price stability remains the current imperative, and it's clear there's more work to do. Again, they claim they're not trying to cause a recession. We know they're going to. The only question then is, how steep will it be due to these aggressive rate hikes? And history will show it's probably likely to be far more severe than any of us actually believe. I remain optimistic there is a pathway to reestablish labor market balance with only a modest rise in the unemployment rate. Again, I'll say good luck to that, while remaining realistic about the risks of a larger downtrend. There's a pathway to reestablishing price stability with a labor market slowdown that only entails a modest rise in unemployment. And I completely disagree with that. At the Fed, we're committed to returning inflation to a 2% target in a reasonable amount of time. Only when inflation is low and stable can the economy in general, and the labor market in particular, work well for all Americans. And I'll ask you this, do you think that this ends well and works well for all Americans? Because I'll tell you what, I sure don't. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.